Hello, everybody. This is Fred Stewart again with Stewart Group Realty, and I'm happy today to be standing here introducing you to another fine loan officer, very experienced loan officer here in Portland, Oregon, Karen Stubblefield. Karen, how are you doing today?
Great, thanks for having me, Fred.
Hey, thanks for taking the time, especially these days where the activity in the mortgage industry and the real estate industry is heating up so much. I really appreciate you taking the time to share the information that we're going to be covering today. Okay. Now, Karen, what company are you with?
Fred, I'm with Penn Financial.
And how long have you been in the the mortgage business?
I started in the mortgage business right when I graduated from college in 1993. So.
Oh, what college did you go to?
Whitworth in Spokane.
Oh, really? Okay, great. And so you've been in since what, 93?
Yes, sir.
Wow, that was a great year in real estate. That was a great year in mortgages. Back then, our average mortgage interest rate was about 7% out here in Portland. So, what's the average interest rate you think the last 30 days?
We're in the low fours.
Low fours.
We bought down below that.
So we're talking about historically low interest rates. Did you think when you got out of college in '93, you're going to see interest rates this low, this long?
Oh, it's crazy. I had a 10-1 arm fixed at 5%, and I thought I'd never sell that house. I sold that house and bought up and continued, and real estate's been good in Portland.
Now, 10-1 arm, explain that real quick so for people who don't understand what a 10-1 arm is.
So especially now in some of our loans that are a little higher than the average, a lot of our clients will be buying at something that's fixed for 7 or 10 years, and it has an interest rate that's maybe half or 3/4% less than a 30-year fixed. And even if you continue to be in that home for an extended period of time, the amount of principal that you can pay down in the first 7 or 10 years is remarkably ahead of a 30-year fix today.
Great. Well, hey guys, the reason I want Karen to explain that to you is, one, not everybody knows what a 10-1 arm is. A 10-1 arm is a very sophisticated loan that is not for everybody, but the people who it's for, it's incredible. It can be life-changing. It can make a big difference in your life as a homeowner. So, as we go through this, understand that the reason why this video is here for you is I want Karen to educate you, and I want you, if you feel comfortable, give her a call and ask her questions about anything we talk about today. Now, today, I'm very excited about talking about something that has really not been present in our market in about 10 years, real close to 10 years. And that is something that a lot of you self-employed people and people who are on 1099 contracts are going to be excited about. And that is the return of the stated loan, or a version of the stated loan. This is the loan that will allow people who are self-employed, who write off much of their income, who really don't show on their taxes how much they really control or how much your income really is during the year, because they are able to write off so much. This is an opportunity for them to be able to become homeowners in this incredible market. So Karen, you got to be excited that you're one of the few companies right now that have this product. I mean, eventually a lot of companies will have it, but you're one of the few that have got the stated loan.
Well, it's nice to be leading the market, and that's why here at Penn Financial, we go through products that make sense in the marketplace. This product actually, we're looking for 12 or 24 months of bank statements. The difference
well, hold on, let's start off.
Yeah.
Let me ask you a few questions that lead you through this, because I want to make sure everybody watching this really understands how powerful this is. Now, a stated loan, what does a stated loan mean in general?
So I wouldn't necessarily say it's fully stated, Fred, because we are asking for those bank statements. I'm going to go through a year or 2 years of your best bank statement that has one bank statement, say your one business statement that has all your cash flow coming in, and then you send it off in 6 different directions. Whichever way you're sending your money, that we know that you have that cash flow and you can cover your bills with that cash flow.
So basically you're verifying the cash flow of what they do, their business, what they control. Because of course, since they own the business, they can pay themselves as much or as little as they want.
Exactly.
Or configure how they pay their bills between the business and themselves. So you said you want to see 1 year or 2 years worth of bank statements.
Exactly. So both programs are asking for somebody to have 4 years in the same industry.
Okay.
So
and
4 years.
Now, when you say 4 years in the same industry, now do they have to be incorporated somehow? Trust? What
Sure.
do you consider a self-employed person?
So let's look at an example of one of my recent clients who owns many properties is a lawyer, an independent lawyer who has so many different businesses and things running. His traditional income, he does not need to pay himself a W-2. So we go through his one primary bank statement for his law firm, and then he sends it out 6 different directions. But from that, he has plenty of cash flow that we can go up to 50 or 55% debt to income on these programs. Really what that means is we use the cash flow coming in. I never want to see tax returns on this program. It's really somebody who is truly self-employed and has plenty of money coming in. I don't care where they send it out.
Now, what kind of credit does the borrower have to be able to qualify
Sure.
for a loan like this?
So on this program, I believe we can go down to 660. The higher you are, for every 20 points in credit, 680, 700, 720 or above, you'll have a greater ability to have less money down.
Okay, so
but
in
it's
general,
still
at
gets in that whole
660,
area.
at 660, what's the down payment?
At 660, what's the down payment?
Mm-hmm.
40%.
40%. Okay, 40%, so that's a 60% loan to value.
Mm-hmm.
And at 720, what's the down payment?
At 720, we need 20%.
So at 720, it's 20% loan. And what interest rates are we looking at here? Let's start off again at the 660. If I come in, I got 40% down, and I got a 660 credit score. What kind of interest rate am I looking at?
So I'd say you're 2.5% above the market rate, since those are always changing. If we were today, here we're in the middle of March 2017, we'd be probably around the 6.5–7% range. If as that changes, that margin will continue to vary as the marketplace varies every day.
Okay, so we're talking in the 7%ers, but this is a stated loan and there's higher risk. And
it gets you in.
And it gets you into the property. Whereas right now, a lot of self-employed people, they write off so much, they effectively don't qualify for a loan at all.
On the traditional terms.
On the traditional terms.
Post-2008, it's been an area void for, as you said, 9 or 10 years. We're coming back,
Correct.
saying it makes sense that you can get back in the marketplace.
Yeah, 40% loan, I mean 60% loan to value, that's a good risk. That's a good risk for any bank. Now, at 720, what kind of interest rate are we looking at?
So 720, you're going to be closer to 2% above the market rate.
Okay, so that'd be about 6 1/4 right now, right?
Yeah.
Right around there?
Yeah.
Okay, so 6 1/4 is where we'd be right now. But understand, guys, we're filming this video here in March of 2017. If you're looking at this video and it's sometime later, what you want to do is look at what the prevailing rate is at that time and adjust accordingly. Now, so you're coming in at 720. At 720, 4 years in business. Bank statements, 1 year.
So if you have 4 years owning the same business, 4 years in the business, 1 year. If you're only 2 years in your current business, but 4 years in the industry, so you have multiple business, but only 2 years in your current license, or in my example, my independent lawyer has bought a different practice, just over 2 years there, or under, right at 2 years, I'm going to ask for 2 years of bank statements. And again, it's your best bank statement, the one that brings in all your money before you disperse it out, whatever directions.
And what do? Average it out over those months? So you average them out over a 12-month or 24-month period?
Exactly.
And then that's what their income is going to be.
So our staff seriously will go through every deposit and go through everything you have there, divide it out in that time period.
Now, does it take longer to underwrite these loans?
The biggest thing here, Fred, is we do all the hard work up front. And I truly believe if we do the hard work up front of getting that information, I'll be very clear on what we need so that you know very quickly whether we have a loan for you or not. Or if there's something we can work for. Now,
when it comes to assets, i.e. the down payment, what is the underwriting guidelines for that? Do you verify that income? Not income, but that money, and how long does it need to be seasoned, if seasoned at all?
So we would verify the source. So it would need to be their own money for, it would need to be the client's own money.
But for how long? I mean, do you allow gift funds and something like this?
We do allow gift funds on owner-occupied programs, not on investment.
Okay, so for an owner-occupied, you allow there to be gift funds. And how long does it have to be in the bank account?
Oh, Fred, you're stepping in a spot where I think it'd be great to have a one-on-one conversation. Everybody's money is different and their cash flow is different.
Okay.
So I think we need to be specific to each client.
What I like about what you're saying here is that you're basically saying it's flexible. You're going to look at basically how the business owner runs their business, and you're going to source the funds, and based on where the funds are coming from, you'll look at seasoning from that standpoint. But they are the seasoning guideline. Now, when it comes to investment properties, what's your LTV on investment properties? Like somebody wants to buy a rental.
Sure. So our investment properties, you do need to have great credit. We need a 740 on investment on this bank statement program, on 60% loan to value, so at least 40% down, and 24 months of bank statements.
Wow. Wow, I have not seen that loan for sure in 10 years.
I'm positive.
Now, God, you got to be excited as heck about this. Now, is there a minimum requirement of how many, not minimum, sorry, maximum limitation on how many properties they can own?
That's an awesome question. I'll have to get back to you on that one.
Okay.
I would highly guess that we're going to be right at 4 on this one, 4 finance. So you can own however many you have in your investment portfolio. We go back to 4 financed at the time that we're closing on the subject property.
Okay, great. That's fair. 4 right now. And so what, the profile of your buyer for this, if right now somebody's watching, what are the 3 things that you would want them to know if they're considering getting this loan for them?
Sure. I gave the example of a lawyer. I would say the other side of have somebody that I'm working with who owns a tow truck business. Mm-hmm. So it's not necessarily just what we look at as professional. It could be somebody who has an independent business. I make no judgments on what people do for a living. I think any way that you have cash flow coming in and we can look at to get you into your home, every family is a jigsaw puzzle, and we work through what that puzzle is today, and thankfully we have some options.
Outstanding. Well, Karen, this is an incredible loan. Everybody's watching this video. If you're thinking about buying your own home or getting into investment property, I wouldn't suggest using a loan like this for flips. But if you want to be a landlord, or if you want to buy your own home and you're self-employed, you own a food cart, you own a bar, you're a dentist, doctor, lawyer, own a landscaping company, this is something that's great for you. This is the first time we've had a loan like this in 10 years. Definitely give Karen a call and go over the particulars with you. Now, one of the things I hope you picked up with her is it's not like this is going to be a loan that is going to fit everybody, but they've got their own system where they're going to make sure the person that gets this loan that this is a good fit. So trust her judgment, come in and sit down and talk with her, and give her the opportunity to see if this loan will work with your plans. Now, Karen, the next thing I want to get into is about this loan before we end this, is how long. A lot of self-employed people, over the last 10 years, they went through heck during the recession. We got bankruptcies, we've got short sales, we got foreclosures, we got divorces. Or I should say, hopefully no divorce, but we got some divorces out there. So what are the seasoning requirements for those situations?
So we'll switch over to one other product, and the reason why I chose New Penn Financial to come with is we have a product that's 12 months out from that event. So it could be a bankruptcy, could be a foreclosure, or it could just be a credit event. Could be that somebody had a car that they just couldn't, keep and had an extended period of time where they're negotiating it out. Any of those credit events, we're 12 months past that, with some other credit that's established or reestablished. So it's amazing what dropping that one item can do to your actual score. And the marketplace says at least 2 years from a bankruptcy on government loans and some other things. We're right at 12 months from that event with reestablished credit.
Now, how can New Penn be so flexible in this market? Are they selling these loans, or are they a portfolio lender? What are they?
So we're a portfolio lender. We're right at the edge of being the top 20 lender right now for money-wise and volume. So it's new to us on the West Coast. I joined this company because I've known some of their senior management 10 years ago when I worked for another large firm. The credit event program just makes sense. I can go as low to 620 to 699. On that, you need 30% down. If we're 700 plus, you only need 20%. Or we can do a refinance, and this gives people cash to buy their next home. So you may have something that you've been sitting in and thinking you can't move up. We want to help people meet their financial goals.
Now, friends, this is a portfolio lender, and for those of you who don't understand what a portfolio lender is, a portfolio lender is somebody who's basically loaning their own money that they control. And they create their own pools of loans or create their own bonds and manage and service their own debt creation. Now, this is a great opportunity for people who sometimes can't go to a traditional lender and obtain a loan because they don't quite fit the Fannie Mae guidelines. And most loans in the Portland market, over 90, I don't know how much over 90, but definitely over 90% of all residential loans in Portland, not counting investment properties, they are done to Fannie Mae guidelines. These people don't necessarily follow those guidelines. They can think outside the box, and they can spend a little bit more effort into learning about their customer and build a relationship with their customer. So understand that's why she's able to offer you products and maybe work with you when other lenders can't. And also, too, let's be straight up about it, it takes a little bit more down payment to work with them. But a year ago, these guys didn't exist. I haven't seen a mortgage company like this in years for the community. And I'm very, very excited that they're back, and I'm very, very excited to bring Karen to you. Karen, thank you for your time. Thank you for all your information. I want to do this again. Is that okay with you?
I'd love to, Fred.
Okay. Karen, what is your phone number?
The best number to find me anytime is 503-956-4883.
And what is your email address?
So it's my initials, Fred. It's KES at newpennfinancial.com.
Now, how do you spell New Penn?
NEWPENN, as in Pennsylvania, financial.com. So that's the last time, KES at newpennfinancial.com.
Great. Friends, like I've always told you, it's very important that you work with experienced professionals in the mortgage industry these days. There's a lot of regulations that we have today that we didn't have 10 years ago. We've got regulations that are going away that we had instilled during the crisis. Not all of them are going to go away. People are being a lot smarter these days than they were 10, 15 years ago. And people like Karen are incredible resources for the market because they've been in this industry throughout the ups and downs and all the changes. So they can apply these changes to what your goals are. So don't feel afraid to sit down and give a talk. Have a talk out with somebody like Karen and see if what she's offering can help you obtain your goals. Anyway, everybody, this is Fred Stewart with Stewart Group Realty. Hope you have a good day, and I look forward to talking with you again and bringing you more interviews in the future. Talk to you later.
Thanks, Fred.